Three stocks I'm buying now. Number one, Adyen. Adyen is a Dutch company that is building a comprehensive payments platform from the ground up. The word Adyen even means start again in Surinamese. In 2021, everyone wanted a piece of this company and the valuation soared to over 80 billion euros. However, the stock has fallen over 70%, taking the market cap to roughly 20 billion. The stock has fallen because of a slowdown in revenue and payment volume growth, and investors are worried about competition from PayPal and Stripe, which could lead to lower pricing. That's a risk, but Adyen remains a highly profitable business with a history of doing the right thing. This table from Bank of America implies that Adyen, Stripe and PayPal are all growing, while legacy providers like WorldPay are declining. Adyen management thinks the company will still hit 25 to 30% revenue growth this year, with EBITDA margins eventually getting back up to 65%. With that kind of performance, the stock looks good value at only 27 times EBITDA. And Adyen also has a pristine balance sheet with 6.4 billion of cash and very little debt. Number 2, Alibaba. In 2018, Alibaba's stock had a market cap over $500 billion, while doing revenues of 42 billion and EBITDA of 13 billion. Today, Alibaba is doing 124 billion of annual revenue and 24 billion of EBITDA, and yet the market cap is only 219 billion. So the company has tripled its revenue, doubled its earnings, but the company has halved in value. Of course, there are some good reasons for that fall. The Chinese government has fined Alibaba billions of dollars for behaving like a monopoly, and buying any Chinese stock right now remains a big risk. However, Alibaba trades at only 7 times free cash flow. That valuation multiple only needs to increase to say 12 or 13 times, and we could see a 50 or 60% upside in the stock. Meanwhile, Alibaba continues to buy back lots of its shares, and it's got plans to break up its business into separate parts. That could help unlock some value. 3. Lantheus Holdings. This is a medical company that we wrote a detailed report about on our website. Lantheus sells an imaging agent for the identification of cancer cells. The drug, called PYL, has been shown to help the early identification of cancers like prostate cancer. Although Lantheus has done okay over the years, its revenue has really taken off after the launch of this drug. Sales went from 42 million in 2021, and they're expected to hit between 835 and 860 million this year. Because of that huge growth, the stock has had trouble keeping up. Shares are up 36% year to date, but the valuation is still only 12 times earnings. Of course, this is a fairly small healthcare company, so it is risky, and the biggest risk is competition. Lantheus currently has a 70% market share, so its revenue could be hit hard if competitors work their way in. That said, Lantheus already has a distribution network in place and several more products in the pipeline as well, so we think the risk reward looks reasonably good. So that's 3 relatively risky stocks, and I do own shares in all 3 of these, but these are my personal opinions, not financial advice.